Last week, the stock market seemed to be an absolute total disaster. It was like riding a roller coaster. First, we had the surging jobs data, and then that led into skyrocketing bond yields. And we know that we've got an ongoing interest rate hike nightmare that's yet to be resolved in 2023. We do not have a Fed pivot just yet, and all of this has led to what I would call bipolar market mode in full blown. First, we're buying, then we're selling, then we're buying again, selling again, and on Friday, we had a massive algo move. An algorithm move is when the market just simply gets too oversold and then people begin to buy and it triggers everybody buying, and it's what gave us this monumental tall-bodied green candle that we now have to analyze and ask ourselves, is this pointing to a complete and total reversal? How do we trade these volatile markets? Should we be trading or investing in these volatile markets, and how do we profit from volatility? I'm going to be looking at that with you guys today, and I'm going to be diving into a popular stock that had a pretty bad day Friday. It was an absolute disaster. I'm going to dive into that, and we're going to ask ourselves, is it going higher? Is it going lower? I'm going to dive into that with you guys today. This is the Stocks with Josh show. Thank you guys for hitting the like already. Throw a heart and say hi in the comments section. Stop trading alone, and if you're not a technical trader, stop trading blind. Join the Stock Josh fam by hitting that subscribe and that YouTube all notification bell. All right, let's get into it. How do we profit from stock market volatility? Well, I'm going to point out some comments from the legendary trader Warren Buffett on this topic. He said that volatility is back, and he said that you shouldn't be scared as long as you're doing one thing, and that's buying stocks with intrinsic value. But of course, that begs the question, what exactly is intrinsic value? Well, in his own words, the Oracle of Omaha said that he pulls the trigger when he can grasp the intrinsic value of an asset, which is discounted value today of the cash that a business is going to generate in the future. So if you are buying stocks that generate cash and the market's in turmoil, then he would tell you, calm down, take comfort. This is an opportunity that you have the ability to buy some of your favorite stocks at a discount. But the problem that most retail investors have is that their entire portfolio is made up of companies that are actually losing money per share. It's a really simple thing to find out if the companies that are in your portfolio are making cash, like Warren Buffett says is the intrinsic value, their ability to continue to generate cash over a long period of time, or actually losing money for every single share that's held by a shareholder. You can simply Google it. Say Marathon Holdings earnings per share, and it'll pull up and it'll tell you how much money per share the company's losing. And so you own an asset. If you own Marathon Digital, MARA, M-A-R-A, you own an asset that represents a company that is losing that much money per the share that you own. In the case of Marathon, for quarter one, they lost 18 cents per share. So for every single share that their shareholders hold, each one of them in your portfolio is represented by an 18 cents per quarter loss in quarter one for Marathon Digital. And so you can now see why these stocks are being unloaded and why institutional money is not necessarily buying them at a fast pace, because they're still in the process of losing money. Now, if you happen to catch an investment when they're losing money and they shift from losing money to making money per share, then you can really get the reward of a massive markup in the stock price. But you're not doing what Warren Buffett is suggesting, which is buying stocks in a volatile market that are being discounted, good companies that are actually making a good profit per share, that you can get them on a discount, and because in the future they're going to continue to make more money per share. Those would be companies like Apple stock or even Nvidia or even Tesla are all making good money for their shareholders, have all been making good money for their shareholders, and will likely continue to make good money for their shareholders. And this brings us to the stock that I'm actually covering today, and that's one that's not making a profit. And it, of course, had some bad news. And when you've got a company that's not making a good earnings per share, it's in a negative territory, if it gets bad news, you should not be surprised if the share value gets absolutely smacked down, because these are high-risk stocks, and the stock market, the investment firms are looking for them to go from losing money to eventually making money. And if they get bad news, then of course they get punished, and that's what happened to Rivian, ticker RIVN. I'm going to take you guys into the charts on Rivian today. I'm going to tell you what I see the bullish and the bearish case moving forward, and I hope that for you guys, you will have a sense of clarity as to what might happen by looking at the charts with me today. But before I do that, if you're looking for free stock and you're wanting to get better trade tools, I want you to check out an offer from the moomoo investment app. That's a zero cost to trade platform that's available in the US, Australia, and Canada. And in each country, there's a different offer for free stock. I want you to click on the link where in the United States, you can get up to 16 free shares. That's right. 16 free stocks for opening and funding an account and doing it with a company offering better retail trade tools. I use them every day, and I host a chat group on the app called Stock Josh Fam. It's a great community. Get your free stock, start investing, and then come find that chat group where you can continue to dive deeper with the Stock Josh Fam. All right, so what happened with Rivian? Well, the stock plummeted Thursday after revealing their plans to issue $1.5 billion in convertible debt. And what are they doing? Well, they're trying to raise funds, and that's called dilution. And what that means is they're going to print more shares, and they're going to sell them typically to private investors or investment firms at a discount. And what that does is it means that all of the shares that are out there, they're borrowing money from the existing shareholders, pulling value, and basically selling it to the open market. It's going to absolutely cause the stock price to go down. Basically, it's a simple rule of supply and demand, and they're increasing the supply when the demand is not strong enough to overcome it. And so with this news of dilution, the stock got punished. It went down nearly 30%, an extremely strong drop. And what's interesting is that this happened right after they had published a beat market expectations on revenue, which was really good news and was looking like it was going to cause the stock to begin to pump. Tesla's been doing pretty good, moving higher, and Rivian seemed to be following suit. Now, I personally like Rivian. I do not put them in the same category as some other EV automakers that are in big trouble and possibly could sink and drown. I think that Rivian does have a future. Now, in an interview with the Rivian CEO, right after they had released their preliminary Q3 revenue, which was, as I said, a beat market expectation, it was quite clear that there was something brewing because the Rivian CEO had dodged a question about dilution, only to then, on the very next day, announce his dilution plans. So is this just all bearish for Rivian shareholders? Not necessarily. I want to give you guys a very bullish chart on revenue that I think tells a huge story and why they had the confidence to go out and get money at this time. This is a chart showing Rivian's loss per vehicle, and what you see by looking at this chart is quarter over quarter, their losses are in steep decline, and so they are quickly moving what I would call to a path of profit. That's why they're using this moment to go out and raise more money. So we're going to have to look at the charts, and we're going to have to see for ourselves whether or not the charts are justifying a 30% sell-off, or if we could potentially get some sort of a V-shaped recovery, or maybe whether we'll move sideways in the days to come. Let's look at the charts. First thing I want to point out to you guys is that we ultimately sold off, like I said, near 30%. And where did we go? We came back to the 200-day moving average on the daily candlestick chart, and we had a nice little bounce. That's a pretty good bullish sign, but if you were to talk to the bears, they would point out that we are actually in a long descending channel with long-term support sitting at $13.50. And trust me when I tell you guys that there are bears who are shorting this stock right now with the expectation that it's going to go all the way back to $13.50, and that's where they intend to lock in their profits. You want to be looking at both sides of the case when you're looking at the charts. So even though we have a bounce, those bears have a $13.50 target. How realistic is that? Well, the bulls would come back and they would tell you guys to look at the local trend, that we had a reversal or a pivot on Rivian when it was back at around $12 on April 23rd, and that even though the stock has pulled back, we're actually still in a controlled and respected upward trend with a clear ascending line of support that we have yet to break. So where are we at? Are we in a short-term bullish move? Are we in a long-term bearish move? Well, let me give you guys some clear support and resistance. Ultimately, if this bounce off the 200-day moving average stays strong, I think that we could backtest the $20 to $21 range. That's going to be the bullish line in the sand because that is strong resistance. Now, it may not get that high because there is a minor line of resistance around $19.90. There's also a point of control there. So if we fail at $19.90, then it means that we're not even going to bother testing the 2021 range. Now, the short-term bearish perspective would be to see a continuation on Monday to a pullback, and what we'd be watching there is that the $18.40 price range, which is support, would need to hold. If it didn't hold, then we need to know that we would then fall back to at least $17.20. And if it didn't hold, I think that we could also assume that we would come back to the support of the $15 price range. And so, from just a really clear perspective, you need to see $18 as a critical support if you're a bull. And you need to just accept the fact that if the $18 price doesn't hold by Monday or Tuesday, then it's very likely that those shares are going back to $15. And you have to ask yourself, am I prepared to accumulate and buy my largest position at 15? Do I believe that much in Rivian? Are you going to be panicking if it came all the way back to 15, or are you going to be buying? And then if you're a bull, if we stay above $18, we then need to see what it does with that $21 strong resistance. I would tell you guys that that will be a brick wall. I would likely see us move up, even in a bullish case, and get rejected there, only to continue to honor a higher low until we eventually break above $21. If you ask me, well, Josh, what's your opinion? You're giving us two cases. Largely, I'm expecting it to chop up that $18 price range until it gives us clear confirmation, and I will cover it. If I see it go one way or the other next week, I will let you guys know. All right, so what we covered today is that if you're going to be an investor like Warren Buffett, the Oracle of Omaha, you should not be afraid of volatility. You should be excited about volatility if and only if you're buying companies with intrinsic value. And he defined intrinsic value as companies that are in the profit and are growing revenue and growing their cash, because those companies would be on discount. And as I've said before, we saw an all-time high with Apple near $200, and it's roughly been 15% off for the last month. And so if you're a long-term investor, this would be a time to consider a company like that. And we also learned that Rivian, even though I like the trucks and I like the EV space, they're not a company that would pass Warren Buffett's intrinsic value test because they've yet to go into the profit. But I showed you a chart that showed that they're on a fast path to profit. They could be a company maybe this year, maybe next year, that actually could pass that intrinsic value test. And as far as the technicals go, we want to see it get above $20 and hold above $20 to be optimistic about the price moving higher. And if we break that $18 mark, we are highly likely to be moving back to $15. And we need to be aware that if the macro environment got pretty ugly at any point this year, that true historic support, according to the bears, is actually $13.50. So be prepared. Now, if you are a long-term investor in Rivian and if you truly believe in the company, that should excite you, as it would be opening up an opportunity for you to be buying this at even a more significant discount. Listen, these charts and everything that I brought to you guys today, I'm going to put that into the Discord. The Discord is the Patreon of the Stock Squad, which has 4 investor traders in there. Stock Up with Larry Jones, Stock Mo, Keenan Grace, and myself. I'm going to condense this with the charts and a few other details, and I'm going to put them in the Patreon today. There's a link over there where you guys can join, where you're going to receive technical teaching, trade signals, and where we're answering questions about the market. Check it out. Hey, and if this was insightful to you, stop trading these markets alone. Gain the insights of my analysis by hitting the subscribe button and the YouTube all notification bell so you can get the next update. Thank you for joining me today. Peace and blessings. We'll see you in the chat. Take care.